Hi, my name's Josh Mahoney, Chief Market Analyst at Scope Markets. I want to talk to you about the impending inflation report due out of the UK on Wednesday morning, 7 a.m. UK time. Certainly coming off the back of a week that has seen a big focus on the Federal Reserve and specifically around about the timing and amount of rate cuts from the Fed next year. Really, it felt like the Bank of England got lost within that. And now that we see this inflation report coming up, it feels like people can focus back again on the potential interest rate differentials in 2024, given the elevated inflation rate that we do see here in the UK. Let's look at the numbers in terms of the comparatives. We've got 4.6% for the October reading. Of course, we are yet to see that November inflation figure come through for the UK. But in terms of the US and the eurozone, 3.14 and 2.4. So significantly lower, significantly closer to target. And that really provides these central banks with the opportunity to be able to ease earlier than the Bank of England. And so the ability to see significant disinflation from the UK is going to be really key to shifting those expectations in terms of next year's easing. This is the current outlook for market expectations around the Bank of England, currently expecting a 96% chance that we're going to see a pause at the February meeting. And certainly, of course, this is February that we're looking forward to. It's just the question mark of what are the expectations at the moment and how could that shift if we see inflation coming higher or lower than expectations. Currently pricing that first rate cut in May, and then we're looking for the back end of the year to be around about 4 to 5 rate cuts from the Bank of England. So the question mark here is, do we see inflation data that helps or hinders the idea that we're going to see that many rate cuts next year? This is the outlook in terms of market expectations according to Trading Economics. Markets expecting that 4.6 figure to come down to 4.3%. The core number, 5.7% in October, markets expecting that at 5.4%. In terms of the month-on-month number, they're expecting a 0.1% figure. Bear in mind, of course, the eurozone did see that minus 0.5 figure for November on a monthly basis. And whilst we didn't necessarily see that sharp decline in terms of the US figure, we're likely to see something more similar just because of the greater reliance on gas, similar to the US, similar to the eurozone, and also similar pricing in terms of those energy inputs. So do we see a low number in terms of inflation as we've seen that slump in energy prices for the UK? That really remains to be seen, but certainly something to keep an eye out for. We've got a whole host of other figures, PPI, which is sort of factory input prices, also worth looking out for, where we're expecting to see an even greater decline in terms of those input prices, minus 3.1% expected for input year on year on the PPI front. So certainly that is the sort of leading indicator of what businesses might do down the line, whether they pass on those savings in terms of lower costs or whether they pass on higher prices. So PPI also a key one to be looking out for. Then in terms of the breakdown for the UK headline CPI figure, 4.6%, like we said. In terms of the recent figures that we've seen out last month, it was pretty much flat at 0%. The more of those that we see, the better, and the sooner we're going to get back down towards target. Certainly, if we're looking for what we're seeing this time around, we're seeing this 0.4 figure stripped out from November 2022, and therefore, a figure significantly below that then drives the the year-on-year figure downwards. But what's notable here is, of course, we have got these chunky figures from February to May. Certainly, once those drop out, that's going to be a significant sort of driver of downside for inflation on that year-on-year figure. Until then, I think there's a good chance that we sort of drift lower, and certainly for that January figure, there's a good chance that we actually move higher because we already saw a negative reading there. In terms of looking at these sort of annualized basis, it's just basically taking a select number of these and projecting it forward. And what it does point towards is that we'd probably have to wait until June for that May figure to come out, and then we'd be way down to 1.3%. So the question mark is whether they move ahead of that, which is quite likely. And that would point towards them potentially easing around about that May time, which is where markets are expecting it at the moment. But certainly if we did see a big chunky number on one of these months, then it would drive up expectations for a sort of longer period of tightening. But if we see a big downside move on the monthly figure and a sharp decline on this current November figure, then that could potentially bring forward those expectations, because that 2.43 figure, which is expected when we're in May, and we've seen that April number stripped out, that would then get closer towards target. So certainly that month-on-month figure is going to be really key. And if we see a significant undersized sort of negative reading, it could really help drive expectations of a sooner rate cut from the Bank of England. In terms of the core number, I think this is an interesting one, because when I annualize any of these more recent figures, we don't get back down towards that 2% target. Certainly, it's similar in the sense that we've got some real chunky numbers that are stripped out as of June when the May figure comes out. But certainly, I think there's a good chance that the Bank of England is going to have to essentially make do with the idea that we're going to see that core inflation reading above target over the near term, and probably have to ease into that. The fact that the UK sort of composite PMI number has come in relatively strong doesn't necessarily point towards this weak landing, per se. It's sort of a soft landing to an extent, but we're seeing strength in the UK services sector in particular, and that could drive up prices. So there's going to be some caution from the Bank of England, and they're going to have to really deal with this, because 5.7% on that core figure, we're not necessarily expecting to see really significant decline anytime soon. 0.3 stripped out this time around. That January figure is likely to, in February, when we see that release, we're likely to see core inflation moving higher. It's only once we see those February, March, April, May numbers stripped out when we see a significant move lower in terms of the core CPI reading. In terms of the chart to watch, I wanted to take a look first and foremost at what's happening in terms of euro sterling. Certainly, euro sterling has been bouncing off this trendline support as things stand. We can see in terms of the, say, daily time frame, that rally up into this near side resistance at 86.34 has faded somewhat so far. And the question mark here is, are markets going to look at that differential between the likes of the ECB and the Bank of England and start to think, well, we're going to see a stronger pound and a weaker euro? If that comes to fruition, then we're looking at the potential for a breakdown through this trendline support and through this 85527. Should we see that move, then it would essentially point towards a strong downside move for euro sterling. As things stand, we're sort of trying to regain ground from this trendline support once again. And so if we see a stronger than expected reading in terms of this inflation report, then there's a good chance that we do see that pound strength come into play and a potential retest of that trendline support. Until that happens, we have, of course, got this near-term rebound coming into play. And if we saw a sharp decline, like I said, there is a chance with that decline in energy prices. If we see a bigger than expected decline in terms of that inflation read, watch out for another potential leg higher here. And the pullback that we've seen in euro sterling leading into it does give us a potential opportunity from a sort of Fibonacci perspective to look for an upside move. As you can see here, the 61.8 really perfectly being respected moving into this announcement.